This is going to be just a quick introduction into fixing a trade that is a zero DTE trade.
I want to sing Eggles because it's Eggles today. Eggles! Please subscribe to our channel.
So if we went over here to this SPX really quickly, and if we were going to set up a trade, and this is late in the day, so it's not going to be perfect type of example, but I'm trying to give you a kind of an introduction to this. You can get more information from the statistical day trading course that we have in the Dorian Way school. And you can also get more information from our video library under the subject day trading. We have a bunch of videos on that for members. If you haven't accessed that video library, please do, because you are a member and you get free access to that video library that has way over 80 videos in it. So with this said, setting up the trade first before we will make some type of adjustments. So normally we're going to try to get $100 on both sides. And so for example purpose, if I sold this and let's say I did something that was 20 points wide, and then I went over to this put side and I sold this dollar amount and did a 20-point wide, that will give me a total right now of $2 or $1 on both sides. So if we're collecting $1 on these two sides, then we're collecting total of $2. Then if something starts to go wrong, once again, before I kind of show these adjustments, this is later in the day. We normally wouldn't put on a trade with only less than an hour before expiration, because you're going to have to be closer to expiration. And you can see this is the at the money line, and this right here that I just pointed out is the expected move. So we're so close, so that any decent sized move down or any decent sized move up is going to cause a problem. But let's say in this example here that the put side, as you can see, is becoming a problem. We're inside the expected move, so we want to adjust this position. So it's a few different type of adjustments we can decide to do. We can decide to do just a roll up, right? So let's just say we had this position was over here and over here, and let's just remove this one for a second. No, we're at the 15. So we can just do a simple roll up and say that, okay, well, I want to move this, I want to buy this, sell that, and then move it up to something like this. Well, if we did that, it's going to give us $120 of additional monies if we just did that roll up, right? But that still wouldn't fix the problem if your trade was this on the put side, and so that wouldn't fix the problem. So we received $120, so we could decide, okay, we're going to take some of that $120 on that call side by rolling it up to move this put side and see if we can do it for less than $100. So if you can see here, we're doing it for less than $100. We're doing it for $70 here. What if we move it a little bit further? Then that's still less than $120, but after fees and commissions, it might be something that's even. So you can move it in this scenario by moving up that call side, but we had to move up that call side to something like a 30 delta, 29 delta. So that might not be, and with this time in the day, with less than, let's say, 50 minutes to go, that roll away might not be a good adjustment. It could be a good adjustment earlier in the day. Okay, so this is the process. You need to know these type of processes, regardless if you're using a stop loss, because what we teach in the statistical day trading course is to use a stop loss, but we also teach to come back in to the trade. So coming back into the trade is like doing an adjustment of what I'm demonstrating here, but it's doing couple steps, right? So you're getting stopped out, an automatic stop loss, and then you're coming back in. But technically that's just making an adjustment, right? If you look at the kind of steps involved in it, it's just making an adjustment. So in this case, I'm showing you how you can do an adjustment, and this is what we call a rollaway. But this might not be the best type of example. Just like that roll up with 50 minutes to go, that roll up wasn't a good one. So the best thing here perhaps is to do the third type of adjustment, and that is a roll out. So let's just assume that your call side is something like this. Okay? Like we had originally, let's say your call side is something like this. So your call side is not worth a lot, right? So if I delete this here just for demonstration purposes, the call side is worth 55 cents, 50 to 55 cents. It might even be worth less than that. But let's look at it and say that the call side is worth that, and we wanted to buy the call side back, and we want to buy the put side back, right? And this is just a 20-point wide spread that we're demonstrated on. This could be a 30-point wide, a 40-point wide, a 50-point wide. It can even be a 100-point wide type of spread that Dr. Metals does quite often, right? But if you bought this back, this is going to cost $1.90 before fees and commissions. Let's just say $2. Okay, this is going to cost you $2, and you're buying it back, right? And so and this is later in the day, but let's say you're buying it back and you want to roll this out. So you can decide that I'm going to roll this out to 1 DTE. So you're rolling it out to next day, and what you're trying to do is just give yourself a little bit more breathing room by getting outside of this expected move. So on the Tastyworks, they give you this kind of ruler here that's giving you the expected move that meets that. It basically is this expected move here, that if you're on the Thinkorswim platform or some other platform that gives you the expected move on the option chain, then it's usually in this far right corner over here. Well, Tastyworks gives it to you in 2 different ways, and this is kind of a really good visual because you can see what's going on. So if I was going to roll this out, I need at least $2 to break even. Let's say we're going to try to get a little more than that. So let's say I went to this 15 delta and did a 20-point wide on both sides. So that's giving me 15. That's giving me 215 already, so more than what I need. So in this case, I'm going to go to the 15 delta 2. This is a 14, so I'm getting 390. So I reposition the trade, and now it's a 1 day to go, and I'm outside of this expected move that we talked about here. So I can decide to stick with this, or I can say, oh, I only needed $2, so I'm getting almost $4. So maybe I can adjust this a little bit. The put side was the problem. So in the Dorian Way, if we have to roll out something, the tested side is what is the problem area, and that was the put side. So the non-tested side based on this scenario is the call side. So we're going to move that away a little further, just in case the market decides to go back the other direction the next day, because maybe it's a little overdone like it is today to the downside. So if I move this call side a little bit, let's say I move this to a 13, keep it 20 points wide, that's still giving me a good. So I move this call side to 11 delta, I'm still getting 320 there. So now that's 11 delta, that's pretty good. So let me see if I can move this put side a little bit. Maybe I can move that to 11 delta and get what I need. So yes, I can still get what I need. So as you can see here in this example, I can do this type of adjustment and move even further away. So I'm at a 9, that's I need $2. And then let's see if I can get out on 9 on both sides, if that's possible. And in this scenario, that is, right? So we need $2, we're getting 225. I would stop here, make sure I get a credit just in case of slippage and fees and so forth. Might even keep the put side at this 11 delta there. Okay. So I can definitely get a nice little credit to make this a type of adjustment. So this is a roll out type of adjustment, right? We talked about the roll up, the roll away, and the roll out. The roll away is a more of a Dorian Way type of adjustment. You learn about that more in course 1, lesson 7. Okay. But if we go back and we talk about this 0 DTE trade again, I want to kind of introduce another type of adjustment that we don't talk about very often, but we've been talking about it more with these kind of short term type of trades, because you're trying to avoid the big loss with your stop loss and so forth. But this adjusting doesn't kind of negate the stop loss. It's just giving you a little bit more time to see if you can win. So if your stop loss is $300 a contract, like we normally teach, then maybe you're making an adjustment when you're down 200 per contract, or you're down 250. You're giving yourself a little bit more time to see if things can play out, and you kind of repositioning the trade. So this is going to be a little bit more tricky now because the market is only 45 minutes to go to close, but I'm going to show you a type of adjustment that you can do as well. So using the same type of example, let's say that the put side is right here and you're trying to buy this back, right? So once again, it's going to cost you about $2.15 to buy it back. Let's say the call side is basically worth nothing, so you're going to buy this back. So what you can do, if you are trading super small, and you should be trading small, at least size wise for your account, no more no more than 2% of your account. If you have a decent size account, you should lose on these type of short-term trades. If you have a smaller size account, then you might have to use a little bit more of your account size, like up to 5%. And you might have to do these things not in the SPX, but you might have to do it in the ES, so you don't have to deal with the day trading pattern rule. But if you want to roll this out again, instead of doing kind of the repositioning of the trade, you can do something like adding a contract if you wanted to. So we buy this back here, and then we can do this in concert because you can see it. And let's say that in that case we bought that back. So now we want to move it back to like the green zone, or what we think is the green zone, as the Dorian Way, as we at what we teach here, the Dorian Way. So you can see if I roll this out right now to a 15 delta, this is giving me a small debit of $10, let's say, before fees and commissions. So I can at this point decide to move this away a little bit more, right, to 11 delta for example purposes, keep it 20 points wide. That's going to give me a debit of 90 cents. But I can decide to highlight this here and then do 2 contracts. So if I did 2 contracts, I just repositioned the trade completely, went into the next expiration period, and added more contracts. If this is okay with your account size and you're trading a lot smaller than what your account could afford to lose and so forth, then adding another contract will give you a lot of wiggle room when you roll this out, and allow you to be able to move this further away. So if we move this down, maybe we can even go to a 9 delta here if we did it. So technically here, after fees and commissions, we probably break even and so forth. We can actually go to this 9 delta. So we literally reposition the trade completely, but we obviously added some little bit more risk because we added another contract. But if we go back to this, this 0 DTE trade, you can see that we're at a 32 delta and have the risk of this going in the money with about 25 minutes to go. So to take that pressure off, we can roll this out to the 1 DTE. We don't have to go out too far in this example, and we can go from a 34 delta to a 9 delta, which will completely change the probabilities. We go from a 34 delta, so you got the 34. You got about a 66% chance to win at expiration here, to going to a 91% chance of winning at expiration, right? But it's a lot more gamma risk associated with this trade right now because it's only, 20, it's only about 25 minutes to go and you are so close at this point. So you got a lot of gamma risk. You got gamma risk regardless because it's a short-term trade, but a lot more in this scenario right now than if we rolled this out here and gave ourselves a lot of breathing room. And then at that point, if we had to make some adjustments, we can always add the call side to make an adjustment. We can do another roll away. We have some more ammunition if we did this type of roll out, right? So you can also do something and just say that your position was just really, really bad. And this is the last example I'll give on this. Say your position is really, really bad and it's something like this, right? So it's in the money here and you're down about it's going to cost you about $550 to buy this back. Well, at this point you can decide, okay, I need $550. I buy it back. And instead of going out one day, you can decide to roll this out a little longer to give yourself some wiggle room. So maybe going out, for example purposes, I'm just going to pick this 45 days for you, so you can kind of see. So we need 500 and something dollars, right? And so we were in the money there. So let's look to see if we can reposition this and be a little further away, 20 points wide. So this is giving us 380. So that's not enough. We needed like at least 590. So in this case, you can roll out and reposition, but this time you adding the call side, and so you keep 20 points wide, and so boom, this is what you had. You needed 550, you're getting 690. At that point, you can decide you can move this away again. You can move that put side away some more if you want from at the money, or you can move this call side away more from at the money, but now you got some more wiggle room